We'll begin the seminar with our guest speaker, Ron Hansen. Ron Hansen was appointed Chief Investment Strategist of GLC in April 2013. He is responsible for economic and capital market research and development of capital market outlooks. As a key member of GLC's investment strategy committees with broad market theme expertise, he is lead portfolio manager for London Capital's monthly income mandate. Ron was previously lead portfolio manager of GWLIM's Mid-Cap Canada and Science and Technology mandates. He has also been co-manager of GWILM's North American Mid-Cap, Quadrus, lead portfolio manager of Ethics mandate, and assisted in the management of GWILM's Canadian equity mandate. Before joining GWILM in 1996, Ron spent 5 years in corporate lending with CIBC and the Great-West Life Assurance Company. Ron is a chartered financial analyst charter holder and holds an Honours Bachelor of Commerce degree from the University of Manitoba. Please join me in welcoming Ron Hansen.
Great. Well, thank you very much for that introduction, Brian, and thank you as well to Mike and Charmaine. It's really a pleasure to be here. What a terrific spread tonight. A round of applause here, I think, for the hosts here, and what a terrific night and what an honor it is to be here. So I'm going to take up hopefully not much more than about 25 minutes of your time, and what I'd like to do tonight is maybe just give you a little quick commercial for GLC Asset Management, the firm that I work for, and then we'll get into some market stuff, talk about some current returns, some of the volatility that we've experienced over the last few weeks and really over time, talk about some of the things that are going on in the market, and then focus down on how an investment manager may look at investing and some of the key things we look at and what we have to focus on. And then I'll finish up with sort of talking about how we should focus on the long term. And certainly investing can be a volatile game, but it's really a long-term game. And investing is a marathon. It's not a sprint. And I really want to make that point as we work through the slide deck today. And hopefully you will get something out of this. So just to start here, GLC Asset Management, we're a wholly owned investment management subsidiary of Great-West Lifeco. We were formed in 2011. We brought together the three separate investment managers of the insurance operations. So Great-West Life in Winnipeg had GWL Investment Management. London Life had London Capital in London, and Canada Life had a firm called Laketon here in Toronto. So in 2011, we brought that together under one umbrella, and we then took the fixed income teams out of each of those locations and formed a fixed income team called Portico. So we now have 4 separate investment managers, and we manage about $37 billion for clients across Canada on behalf of Great-West Life, London Life, and Canada Life. So we're a good-sized company. With that, let's sort of move into just a quick look at returns. Now, this slide is quite busy, and I don't want you to worry so much about the numbers, the specific numbers, but what I want to do is just draw a few points out of here. And so in the top box, I'm showing returns for the TSX Composite, the S&P 500, and the TSX Small Cap Index. These numbers are to October 24th, and it wasn't that long ago that the Canadian equity returns this year were outpacing the U.S. equity returns. But that gap has narrowed, and as a fact of today, the U.S. equity returns are outpacing Canadian equity returns. And you only have to look to the bottom right panel to see why that is, and that's because the Canadian equity market relies heavily on resources, and over the past while, resources haven't done all that well. So I'm sure you're all aware of the decline in oil prices. Oil prices down about 18% year to date, and that's weighed heavily on the Canadian stock market, and in particular small caps, which are down year to date now. Then in the bottom left corner, with interest rates down this year, bond market has done quite well. So when interest rates decline, bond prices go up. And so you can see in the bottom left corner, bond returns year to date about 6%. So pretty healthy returns both in bonds and equities this year. So you're also probably aware of that October was quite a volatile month, and we've had a nice little bounce off the lows here. And in fact, the S&P 500 as of today is back up to new all-time highs. The Canadian market has lagged a little bit, again due to the resource exposure. We have to admit the quick rebound in the S&P 500 has been a little bit surprising. But through the whole piece here, we've remained quite positive on the longer term. So when we look beyond just some near-term volatility, when we look out 6 to 12 months, we think there are some positive factors supporting equities here in North America, particularly the US, but also outside the resource sector in Canada as well. On this slide, I'm just trying to put the current correction in context. So here we're showing changes from the maximum highs over a period of time. So you can see by this chart that equity markets are volatile, and equity markets tend to correct, and they tend to correct quite often. In fact, the recent correction of 11% is quite normal. So the TSX reached a high of about 15,600 in September, and into the low on October the 15th, market was down about 11%. We've gained back about 5% of that since October. But it's important to know that corrections are typical and normal, and they're healthy over time. And it's very important not to overreact to correction in the stock market. In a recent study by JP Morgan, they showed the impact of investing $10,000 in the S&P 500 Total Return Index from December 1993 to December 2013. And if you kept that $10,000 invested the whole time and never changed it, by the end of the period, excuse me, you had $58,000. However, if you missed the 10 best days of the market in that time period, your return would only be $29,000. If you missed the 30 best days, you would only have $11,900. So you'd only made $1,900 over 20 years. And if you missed the 40 best days, you would have lost money and only had $8,000. And the other thing is, oftentimes the best days in the market occur after the worst days of the market. So it's very important to stay invested. And it's also important to have a disciplined asset mix, have a well-diversified portfolio, and if you stick to those targets, you'll avoid selling at the bottoms, and in fact, you'll find yourself buying equities at the bottoms if you can stay disciplined, and that's where people like Mike and Brian come in handy to keep you disciplined and keep you focused on the long term and make sure you're not panicking at the bottoms. So one of the big things here in terms of not panicking at the bottom is about cutting through the noise. And there's always a lot of headlines, particularly in today's day and age, in the digital day and age, internet. Everybody has access to information, everybody gets information quickly, and everybody reacts to information quickly. So it's important that you step back and take a look at the big picture, and you rely on professionals to manage the money for you. And that's our job, to cut through the noise, if you will. So there's a number of macro things that are always going on, and currently some of the things that we're focused on at GLC Asset Management, I'm going to highlight right now. First of all, monetary policy. Obviously, global central banks are in focus. So the Bank of Japan just last week increased their quantitative easing program. The Federal Reserve in the US, they stopped their quantitative easing program. The European Central Bank meets tomorrow. They're under pressure to do more to help stimulate their economy. The Bank of England is talking about raising rates. All this is impacting capital markets globally, and something we have to monitor. The U.S. and the Canadian economy, I'm going to get into a little bit more detail in a couple slides here. The U.S. economy appears like it's starting to gain some momentum and recover. The Canadian economy is lagging a bit, but we expect the Canadian economy to be pulled along a little bit by the U.S. economy. Then in the Eurozone is struggling. Deflation is a major concern. Growth is starting to stall. And certainly the ECB is under pressure to act. And we actually think it's going to get worse there before it gets better. Then in emerging markets like China, growth is slowing. Absolute growth rates are pretty good, but the rate of growth is slowing. And in a market like China, you have concerns with the property market as well as the debt markets in terms of shadow banking. Then the final point on this slide with respect to geopolitical risk. Some of these risks have faded from the headlines, but just 2 weeks ago, they were center stage. We were worried about the breakout of World War III as the U.S. announced attacks on ISIS into Syria. Russia, Ukraine, the ceasefire looked fairly tenuous, and there was certainly news about Ebola in the headlines every day. And this has an impact on capital markets. Historically, this impact is transitory. It creates a bit of volatility, but markets typically recover from it. And right now, we're sort of experiencing that, where markets have made a nice recovery from these geopolitical risks. But they're still there. They're ongoing. On this slide here, what I'm trying to highlight is global GDP, and despite all the noise, the underlying trend in global economic growth hasn't really changed. So this notion of modest and uneven recovery hasn't really changed, despite some of the headlines we've seen over the past several weeks, whether it be the IMF downgrading their global forecast a few weeks back, or just this week the European Union downgraded their outlook for the Eurozone. But at the end of the day, the consensus forecast really hasn't changed that much. Global GDP is expected to grow at about 2.5% this year and 3% next year. In fact, the IMF, when they downgraded their forecast just a few weeks ago, they took 2015 global GDP down from 4% to 3.8%. You can see that's still well above what consensus forecast is. But if you just read the headlines, you would swear the sky is falling and you had to run for the hills. So again, it's very important to sort of cut through that noise. Another point I'd like to make on this slide is with respect to the difference between absolute growth rates and the change in growth. So in emerging markets, absolute growth is actually quite high. So on this slide, I'm showing China growing currently at about 7% a year, but this has slowed down from double-digit 10% range, 9% range. So high absolute growth rate, but at the margin that growth is slowing. When you look at economies like Canadian and US, yes, the absolute growth is much lower at about 2 to 3%, but it's improving. It's going from 2% to 3%. And even in the Eurozone, where growth is sub 1%, it's going from sub 1% to above 1%, and the same thing in Japan. And that's an important point, because markets don't price absolute levels of growth. They are more concerned about whether things are getting better or worse. And things are getting better or worse in developed markets, and in particular in the US economy. So on this next slide, it's also a little bit busy, but I won't dig too much into the details here, but it's just to try to make a point about the U.S. economy. I'm not saying the U.S. economy is firing on all cylinders, but it is improving. So in the top left panel, the housing, or the labor market, the job market, the unemployment rate in the U.S. now is below 6% at 5.9%. This is the lowest rate since 2008. The U.S. economy is adding jobs on average at about 245,000 a month, and we have some new data coming out this week. Expectations that U.S. will add about 230,000 jobs in October. So there's still some slack in the U.S. labor market, but it is improving. Housing market, same thing. We've come a long way from the bottoms in 07, 08, where housing starts were running at about 500,000 per annum. The latest statistics, over 1 million starts on an annualized basis, and growing 8% year over year. So yes, on a month-over-month basis, we're seeing a little bit of slowing momentum, but when you step back and look at the trend here, the trend is still intact. Bottom right corner, auto sales, same thing. The U.S. is selling over 16 million units per annum. This has slowed a bit from a high level of 17 million in August. But we're still over 8% a year. So again, pretty good momentum. And then in the bottom left corner, we have industrial production. Capital investment in the U.S. Over the past few years has lagged a bit, but we're starting to see that pick up. And industrial production is running at about plus 4%. And then to top it all off, I talked about the oil price a little bit to start with. And this decline in oil price and the subsequent decline in gasoline prices, this is like a tax cut for the U.S. consumer and the Canadian consumer, maybe not to the same degree. But I've seen estimates that the dollar drop in gasoline is worth about $70 to $100 billion a year for the U.S. consumer. So it is like a tax cut. And as long as the decline in oil right now is driven by an increase of supply and not because of slowing demand, i.e. slowing global economic growth, then this decline in oil prices is a net positive for the U.S. economy. Turning to the Canadian economy, we refer to the Canadian economy as being somewhat stuck in the middle. So on the one hand, you have slowing growth in emerging markets, big consumers of commodities. Obviously, Canada is a big producer of commodities, and that presents a bit of a headwind. On the other hand, you have the U.S. economy gaining momentum, our largest trading partner, and that acts as a bit of a tailwind. So we do expect the Canadian economy to improve. You saw the consensus forecast, just over 2% this year, 2.5% next year, and we think that's reasonable. In the top left panel here showing Canadian job growth, and you can see it's a lot more inconsistent and volatile than the U.S. Job growth this year has been somewhat tepid at less than 1% compared to over 2% for the U.S., and it's been very regional in Canada, with most of the job growth occurring in the West and Alberta, driven by the oil and gas industry. Then in the top right panel, despite the leverage in the Canadian consumer, retail sales have held in pretty well. But here again is another statistic that we've seen in August, September, where the press focuses on the month over month. But when you look at it on a year over year basis, momentum is still positive at 3%. But given the highly levered consumer in Canada, I don't think we can rely on the consumer to drive economic growth as we move forward. And policymakers are relying on a transition from a consumer-led recovery to non-resource manufacturing and non-resource export growth. So in the bottom right panel, we're showing export growth. It's running at about plus 8% year over year. The recent trade data just out yesterday was quite constructive, but still largely driven by strength in resources. So we still haven't quite made that transition to non-resource manufacturing. And then with respect to industrial production in the bottom left corner again we're seeing some improvement, but largely driven by resources. And we expect that to improve a little bit as the U.S. economy improves, and a lower loonie should help the Canadian resource manufacturing base, in particular here in Southern Ontario, what's left of it. So, the bottom line here for the economy, modest, uneven recovery globally, but we think the U.S. Can continue to move forward, even with slowing in the Eurozone and some risk in China. Keep in mind that the U.S. economy is very insular. 2/3 of the U.S. economy is driven by the consumer. So not a lot of the U.S. Economy is driven by what's happening globally, and that's why we think that perhaps the U.S. economy can continue to gain momentum. So as we move away from sort of this macro view, the bigger picture about macroeconomics, I want to focus you in on some fundamentals in terms of the core fundamentals of investing. And so valuation, what do you have to pay for to own stocks? So what do you pay relative to the earnings level? What are earnings doing? Are earnings growing, or are they contracting? And are the earnings at a level that can support dividend payments? That's very important. And then finally, what's the cost of money? What are the level of interest rate? What's the literally the opportunity cost of not owning equities, if you will? So on this first slide, I'm showing valuation. So this is the PE ratio for both the TSX and the S&P 500. What is the PE ratio? Well, the PE ratio is the price level of the index. So when you hear or read in the newspaper or see on TV what the TSX was today at 13,000 or 14,600 or whatever it closed at today, divided by the earnings level, that's what we call the PE ratio. That's the valuation. And on this chart, you can see that these lines are above the historical average. So the valuation is above historical averages. The market is not cheap, but we're also not at extreme levels. And over the past few years, a lot of the gains in the stock market have been driven because this ratio has gone up. So it's moved higher. So if you think about it this way, if a company earns $1 of earnings and the market's willing to pay 10 times earnings, that stock's $10. If that same dollar of earnings and the market's willing to put a 15 multiple on it, the stock is $15. And that's sort of what's happened here, where market multiples have gone from 11 to 15, 16 times. And that's what's been partially responsible for the gains in the equity markets over the past couple of years. And as we look forward, we don't think multiples are going to expand. What we think we need to see is earnings growth. And so here I'm showing earnings growth again for the U.S. and Canadian markets. Consensus forecast for 2015 is high single digits to low double digits. We certainly think that's reasonable for the U.S. We think there's some risk to the Canadian estimates, but nonetheless, we think the direction is correct. So we think earnings provide good underlying support, and if earnings can grow at 8 to 10% and the multiple stays flat, and you add a dividend to that, that sort of drives your return. So 8% earnings growth, 2% dividend yield, you sort of have 10% gains in equities on a theoretical basis, and we kind of think that's where the markets are heading over the next 6 to 12 months. So then this other notion, equally important, as earnings grow, what is the ability of companies to pay dividends? So given that outlook and the strength of corporate balance sheets, we think both Canadian and American companies are well equipped to continue to pay as well as grow their dividend streams. And on this slide, what I'm showing is something called the dividend payout ratio, and this is for the U.S. market, and it shows dividends relative to earnings. And you can see the dividend payout ratio showing companies' ability to pay dividends is below average in terms of how much they're paying, so that's a good thing. So companies have the ability to pay dividends, and dividends, as I'll show you in a few minutes, are very important to total return over time. And the current dividend payout ratio is very typical for a non-recessionary environment like we're in today. Finally, money is cheap. We all know that interest rates are at a historic low, and not just here in Canada and the US, but globally, and I'm showing a number of different government bond yields across the globe. We do expect, as the U.S. economy starts to improve and the Federal Reserve starts to normalize their monetary policy, that interest rates will start to gradually rise. And we think that's going to weigh on fixed income returns because, remember, fixed income prices go the opposite way of interest rates. So as rates rise, bond prices go down. So because of that, we think investors should have relatively modest return expectations on their fixed income portfolio. So that's something to keep in mind as you think about expectations for returns in the coming years ahead. So how does this all translate into a market outlook, and how do we see the market evolving over the next 6 to 12 months? So we think equity returns should outpace bonds again over the next 12 months. We think in the near term we maybe see some volatility, but fourth quarter is typically seasonally strong, historically in particular in midterm election years. So as we look out over the next 6 to 12 months, we think equity should move higher. I talked about North American equity valuations being above historical averages, but we have good earnings support. So we think earnings can drive North American equities over the next, again, 6 to 12 months. I haven't talked a lot about Europe, but I did mention that the European economy is struggling. We think it gets better before it gets worse. There will come a time when there's an opportunity there because, again, markets look forward. They don't care about absolutes. They care about things getting better, or are things getting better or worse. And we think it's going to get worse before it gets better in Europe, so we prefer North American over European equities. And we also prefer developed markets over emerging markets. Despite over a longer time period, emerging markets are really what's going to drive global growth. Over the next 6 to 12 months, we think emerging markets have some headwinds, and we're a bit cautious in the near term. And then finally, with respect to fixed income returns, again, modest return expectations. We think rates are going to rise. We think in the near term here, rates have been suppressed by a number of different factors, including what's going on in Europe, and some other factors with respect to geopolitical events and flight to safety, et cetera, that have suppressed both U.S. and Canadian interest rates. But in general, you should have modest return expectations for fixed income markets. Okay, investing for the long term. So stepping back a little bit from what we do on a day-to-day basis, where we have to understand what's going on on an intricate level in terms of every day and dissecting all this information that comes in every day, what really matters over the long term. So here on this chart, what I'm showing is returns from the lows of 2009. And this might surprise a lot of people, actually, to see just how strong equity returns have been since 2009. So the U.S. market, the S&P 500, has almost tripled from the lows, up nearly 200%. The Canadian market is up nearly 100%, so almost a double. And then the EFI, the European and Japanese markets, are up almost 100% from the lows as well. These represent compound annual growth rates for the U.S. market of just over 20%, for the Canadian market, and the EFI index of about 12 to 13%. So these are pretty strong returns. So given these strong returns, I think retail investors are asking themselves, have we missed the boat? Worried that they've missed these strong returns. And we think going forward for equities, return expectations should probably be tempered a bit. I don't think it's realistic to expect that you're going to get 20% a year for the next 5 years in U.S. equities, or even 13% a year for Canadian equities. But we do still think that the bull market is intact, and equity returns should be okay, and certainly better than fixed income returns over the next few years. Investors may not have missed the boat. There's still opportunity there, but a lot of retail investors haven't been on the boat yet. And we can see that in equity flows, both in the industry and what we're seeing with our company. So we're still seeing net withdrawals in Canadian equity funds. And that's not surprising given the experience we've had over the last 12 or 14 years. So the crash in '01 and also in '08 certainly rings true in a lot of people's minds. And I'm sure in a lot of your minds still remember the crash of 2000, 2001, and of course of 2008. But it's very important to focus on the long term. And so I want to take you through some long-term numbers and why you need to focus on the long term. So over time, markets tend to go up. So I'm showing here market returns for the last 85 years. And of 29 of those 85 years, the market was down. 56 years, or 2/3 of the time, markets were up. In a little bit of shorter time period, since 2000, markets have only been down 4 times. And they've been up 10 times. So those are pretty good odds. As long as you can keep a long-term focus, you're probably going to make money in equities. And I'll show you that in a little bit more detail as we move through the slides. So on this slide here, I'm showing the duration and average return for bull markets versus bear markets. So on average, a bull market is up 82% and a bear market is down 28%. And on average, in the last 60 years, a bull market lasts for 3 years, and a bear market, again, lasts for just over a year. So again, this notion of markets tend to go up over time, and it's important to keep that long-term focus. Another way to look at this is how risk reduces over time. So equities are riskier than many other investments, and when you have a short-term time horizon, when you look at it over a year, they're particularly risky. Returns can also be high. So over the last 60 years, the best you could have done in 1 year is 44%, and the worst you could have done is 33%. So many of in this room don't want to absorb a 33% loss. But you can see how quickly the loss, your time horizon reduces your risk. So in as little as 5 years, that risk of loss has almost been eliminated. So the worst rolling return over 5 years is 0.3% negative. And over 10 years, the worst rolling return is 3.4% in equities. And over 20 years, your worst 20-year period is plus 6.7%. So again, investing is a marathon, not a sprint, and you have to keep focused on the longer term. The benefits of a diversified portfolio, another tenet of successful investing. So over time, equities do outperform bonds typically. So showing returns here from 1998 to 2014. For a portfolio, 100% equities invested in the S&P TSX total return, you'd have earned 8.8%. If you were 100% bonds in the FTSE TMX total return index, you'd earn 5.92%. And if you were half invested in bonds and half invested in equities, you'd earn 7.36% over that time period. Where diversification really matters is in short periods of time, like in 2007, 2008, when equities were down 33%, but bonds were up 6%, and if you were in an equally diversified portfolio, 50-50, you'd have only been down 13%. The other important thing about a well-diversified portfolio and sticking to that target asset mix is it keeps you disciplined. So in 2007, 2008, when equities were down, your mix into equities would have went down. If you would have then rebalanced your target mix, instead of selling equities when equities were down, you would have bought equities. And I showed you earlier what equities have done since the bottom in 2009. And so it's very important to maintain that discipline and maintain that asset mix that's that is consistent with your risk tolerance. So that's very important over time. Then on this final slide, I want to show you something about dividends and the magic of compounding. So here I'm showing the impact of investing $10,000 over the past 10 years, since 2004 to 2014, invested in 3 different benchmarks: the S&P TSX Composite Price Only, the S&P TSX Composite Total Return, and finally the Dividend Aristocrat Total Return Index. So the TSX Composite, price only, no reinvestment of dividends. So investing $10,000 in October of 2004 today, you'd have $16,500, assuming you kept that invested over that period of time. If you invested in the Total Return Index, including dividends, but remember, not all stocks in the TSX pay a dividend, you would have $21,700. If you invested in an index that every member paid dividends, you'd have $30,200. So you can really see the magic effect of compounding and how important a role dividends play in an investment strategy over time. In addition to that, dividends not only augment returns, but they protect the downsides. Think of it this way. If you own a stock that's priced at $100 that pays a $5 dividend, after a year, that stock has to go down below $95 before you lose any money. After 2 years and you've received 2 dividend payments, so $10, that stock has to dip below $90 before you lose any money. So, the magic of compounding is incredibly powerful, and I know that's something that Mike certainly adheres to in terms of the importance of investing in dividend-paying equities, and it works over time, and this chart illustrates that. So what would I like to leave with you tonight? I'd like to leave with you a few keys to what we see as investment success. So cut through the noise. Sometimes you have to just cut through the headlines and ignore all the headlines. That's for the professionals to worry about. Does this really change the underlying fundamentals? As an individual investor, you have to understand your risk tolerance and set your return objectives accordingly. So if you're very risk averse, you shouldn't be 100% equities. If you have high risk tolerance, then you should have more exposure to equities, and then have return expectations that are consistent with that risk tolerance. Secondly, set a well-diversified asset mix consistent with number one, and these are the things that people like Mike and Brian are here to help you with. Number three, success is driven by time in the market, not timing of the market. So I stole this quote from David Rosenberg, but I think it's very powerful, and you saw that in the slides in terms of it's impossible to time the market, and if you just stay invested, markets do correct. That's normal and healthy action, and it's the worst thing you can do is sell into corrections. And then finally, dividends drive total return. Let the magic of compounding be your friend. So, investing can be very complicated, but at the same time, it can be very simple. And I think if you stick to some simple principles in terms of well-diversified asset mix and stick to that asset mix consistent with your risk tolerance, then over time you'll be successful. And I'm not sure if we have time for questions, but I'm happy to take any questions. But we have a few minutes if you do want to ask any questions. Go ahead. Well, I think at the short end of the curve, rates will continue to be held low. In the U.S., I think the Fed's going to start to raise rates mid-2015. I think the U.S. economy is going to continue to improve, and the Fed is going to have to raise rates. I think the Canadian government is going to wait and follow the U.S. Several months after. So I think mid-2015 for the U.S. at the short end, and later in 2015 and maybe early 2016 before we see a change in policy rates in Canada. But I think as the North American economy continues to gain momentum, we're going to see the 2 and 5 and 10-year rates start to move higher over that time. It'll be a gradual rise, but as the economy improves, we are going to see interest rates rise. Well, we don't make direct investments in China. Our firm invests directly. I shouldn't say that. We do have some global funds at London Capital, the Infrastructure Fund and the Global Real Estate Fund. But we're primarily focused on Canadian and U.S. equities. But certainly, what's going on in China has an impact, particularly on resource stocks in Canada. As far as a trade junket to China, I think there's no doubt that the emerging market and the demographics in emerging markets are the future of global growth. But that's going to evolve over time, and I think Canada has to deepen those relationships for obvious reasons. But that's going to take time, and will evolve over time. And I think from a resource perspective right now, we're a little bit cautious on commodities in the near term, and that obviously impacts Canadian equities because a big portion of our market is resources. So, we're seeing some of that impact in the oil market right now, as well in base metals. So certainly, I think the secular bull market that we saw in commodities through 2001 to 2008 is behind us, and we're going to come back into normal sort of short-term 2 to 3 year cycles in commodities as we move forward. Okay? Any other questions? Well, terrific. Thanks so much for your attention, and enjoy the rest of your evening.